Thank you for joining us at XM.com. You're watching today's Daily Market Comment by Raf Boyajian. I'm Cristina Marujos. After ending February on a sour note, equity markets started the new month in a cheerier mood with the help of some much-needed positive headlines from China. Manufacturing activity in the world's second-largest economy grew at the fastest pace in more than a decade in February, and the strongest sign yet that demand and supply are being fully restored following the lifting of all COVID restrictions in December. Hong Kong's Hang Seng Index surged by more than 4% on the back of the upbeat data, while China's benchmark CSI 300 index jumped 1.4%. For global investors, any positive takeaway from China has to be weighed against the angst about central banks overreacting to the inflation threat and causing a hard economic landing. Those lingering risks are holding back the gains in Europe and the US. Shares in Europe and US E-mini futures are up only marginally. All of Wall Street's main indices ended February in the red as traders were forced to reassess how many more times the Fed will raise rates in 2023 following a series of stronger than expected US data. However, this week's releases have been rather mixed, adding to the uncertainty about whether or not the US growth is slowing or accelerating. Investors will be hoping that the ISM manufacturing PMI due later today will shed some more light. In the meantime, bond yields continue to edge up, with Eurozone yields in particular racing higher as the European Central Bank begins running down its balance sheet today. But the uptick in yields is likely a reaction to yesterday's hotter than expected flash CPI figures out of France and Spain ahead of tomorrow's Eurozone ones, and expectations for the ECB's terminal rate are up fast and approaching 4%. This is giving the euro a significant leg up against the US dollar, hitting a one-week high earlier in the session. Among the commodity-linked currencies, the New Zealand dollar is leading the gains by a wide margin. The optimism around the recovery in Chinese demand is likely driving the risk-sensitive Aussie, Kiwi, and Loonie higher. But the Bank of Canada pausing and question marks about how much further the Reserve Bank of Australia will tighten, only the Kiwi is able to stage a solid rally today. Thank you for watching the Daily Market Comment here at XM.com.